You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you are doing well on this Tuesday. Today, we are going to talk about the perfect time frame to analyze a stock. So, regardless if you're looking to buy or if you're reviewing one of your company to ensure that the business is doing well, you must review that company's financial metric at one point. So, I really like when I make the difference between my investment thesis, so the narrative, the story behind a company, and then I match it with real life numbers. But then comes the idea of, okay, so how long should you go back to take a look and do a good analysis? So your search will start probably from a stock screener. If you're looking to buy a new stock, you pull out a stock screener. The main advantage here and the usage of a stock screener is really to narrow down your choices because it's virtually impossible to analyze like 2,000 companies. So you're better off setting some basic metrics. Now, when I do my stock screener, I try to keep it relatively large, relatively wide in terms of search because I don't want to narrow it down too much at this point. I know that a single number, even if it's a 5-year or a 3-year or a 10-year average growth rate, it will hide a lot of information that will be found on a graph. So at first, I'm just looking at 5 years for the stock screener, looking for positive numbers around my dividend triangle. So when I pull out the stock screener, I'm just asking for revenue growth over the past 5 years of 1%. Same thing for earnings. And most of the time, I will raise the bar a little bit more for the dividend growth and ask for a 5% average growth rate over the past 5 years for the dividend growth. Why? Because regardless of what happened in the past 5 years in terms of revenue and earnings, I want to make sure that the business is able to sustainably increase its dividend. It's even more important right now because we are in 24. So this means that you're going to get numbers between 2019 and 24. And in the middle of that, we have COVID, which had a huge impact on financial metrics for many companies. So we're now right before the pandemic hit. So when I'm looking at Alimentation Couche-Tard's graph, for example, I see that between mid-2019 and 2020, there was a slight slowdown in the revenue. And then between 20 and 2021, of course, it was a huge drop followed by a huge increase. And you're going to see that for a lot of companies. So at first, I do the stock screener, 5-year metric for the average or the analyzed growth rate. And that's the only thing I do. Then I will look at the company's financial metric in the form of a graph. Why? Because this is where I'll be able to draw trends. And the trends, my friend, is your friends. Yeah, I know it's cliche, but it is exactly what it is, right? If you just look at numbers, you will miss something that is going on. I remember that a few years ago, if you looked at the 5-year dividend growth rate for Rogers, for example, Rogers increased its dividend a few years ago. So the last time was in 2019. So if you were looking at the dividend growth rate in 2020 or 2021, you would have a positive dividend growth rate. But in reality, in 2016, it was paying 48 cents a share. 2017, same thing. 2018, same thing. 2019 went up to 50 cents a share. And since then, has still been paid 50 cent a share. So long story short, if you just look at the past year or the past 2 years, you're like way too close to what just happened and you're going to miss something. So I like to look at a company's graph with 3 different time frame. My favorite one, I'll tell you at the end, but the first one that I look is the 3 years time frame. So the past 3 years will tell you a lot about what has recently happened. So what recently happened has a much higher chance to replicate in the future, especially if you know more about the business model, if you have a strong narrative and you understand where the business is going. The past 3 years will tell you a lot. Right now, when we look at businesses, we look at 21 to 22, 22 to 23, 23 to 24. So of course, a lot of companies will show you great growth starting at the bottom point of 21. Is it ideal? Definitely not. And I kind of like that we have the pandemic right now in the middle of our stock graphs. So we can see that looking at 3 years is a bit too short. So the real reason why I like to use the 3 years is to see what is likely going to happen in the future. So we see the shortest trend, trying to determine that, but for the long run, it's going to be very hard to project those numbers in the future. Then you have on the opposite side the 10-year metrics. So I have at Dividend Stocks Rock, all our graph shows for 10 years. So that makes it very easy for me. I don't have to go get those numbers anywhere else. And what I like about the 10-year is not actually the growth from 2015 all the way to 2024, but rather to see how that trend is going. So for example, with Alimentation Couche-Tard, I can see that there was not much growth between 2015 and 2017, but then some acquisition fueled the numbers, and then between 2017 and 2019 we had a pretty big rush. So revenue went from roughly 35 billion all the way up to 59 billion in a couple of years. So that tells us a lot, because then you need to understand what happened back then. Was it like a new innovation, like getting new market share, improving new products introduction, or in this case, definitely an acquisition? Then you'll see how revenue will fluctuate versus earnings, which is great. Again, what I like to use at DSR is to see them in the dividend triangle graph, because I can see each year how revenue moves versus earnings. So that tells you a lot about pricing power, about how the company can manage their margin, which is super interesting. And for example, for revenue in for Couche-Tard between 2020 and 2021, of course, it was on a downtrend. And then for the earnings per share, it remained stable. So that tells us that the company found ways to improve margin on a very bad year, which is great, because then you know that management has on their business. They have some tricks up their sleeves, and they are able to make the business better if needed be. So great adaptability skills here. That's what I like. The problem, though, when you look at 10 years is whatever happened in 2015, 2016, it's long gone. I mean, think about that. Back then in 2016, we didn't think about inflation. We didn't think about high interest rate. We didn't think about the oil market was a lot lower as well. And we thought that we might enter into recession. Well, we might enter into recession right now, but for a lot of different reasons. So once again, what happened 10 years ago, 8 years ago, not that relevant. So the 10 years is used for analyzing the trends and see how the revenue, the earnings, and the dividend are reacting one versus another. Finally, my favorite one is the 5 years. Of course, it's just like getting between the 3 years and between the 10 years. It gives us a little bit more perspective. While the 10 years will show us a full economic cycle on average, the 3 years is giving us the short trend. The 5 years is giving us a little bit of both. So that's what I like to see. Okay, so what happened over the past 5 years where we are capturing a good part of an economic cycle, but not completely? So it gives us a little bit more information on both sides. But of course, it's important to have the three lenses. So I always start with the 3 years to see where the company is going. Then I look at the 10 years to have the average trend and see how each metrics put in time and into a context to remember like what happened in 2017. So what was the market at and how the economy was going. So then you look at how the company was doing. And finally, the 5 year is really my favorite metric because it gives me both the short and the long trend. So then it's a little bit more permissive. So if the company went into a bad year, well, across 5 years is going to be diluted a little bit, while in 3 years it's not going to be. So that's why I prefer to end my analysis by looking at this latest segment. All right, Moose, that's enough for today. I hope that you have enjoyed this podcast. If you did, well, please give me a 5-star review on Spotify or on Apple Podcasts. We're well above 200 rated 5 stars review now at Spotify. I thank you so much for that. And we're going to talk again tomorrow. So until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.